Hi, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting. We appreciate you joining us for this installment of Charts of the Week for May 29th, 2020. This is our weekly presentation of charts that in the course of my research and daily reading that I come across that I think are helpful in illustrating a point related to the market or the economy that we think might be illustrative to show our clients and friends of the firm. We hope you like this installment. Please see our disclaimer for important information. On this chart, published by Guggenheim Investments in a recent research report, it highlights the massive amount of Treasury issuance that we're expecting here in 2020. And you can see this trend line dating back to prior to the last recession, which was 2008-2009. You can see that this is really an unprecedented amount of net marketable Treasury issuance for any year that has been measured of late. And even during the 2008-2009 timeframe, which is a massive amount of, represented a period of massive dislocation in the financial markets, we never saw anything like what we're expecting this year. In fact, that purple bar on the far right-hand side for 2020 is actually going to be closer to probably around $6 trillion. But the key things to kind of talk about here and things that were echoed in the research from Guggenheim was that, if the markets ever begin to question the efficacy of this quantitative easing, this massive amount of Treasury issuance, or if the Federal Reserve is perceived to be kind of behind the curve in making necessary asset purchases, we could very well see a significant, what we call a tantrum in the bond markets, which could spill over into other forms of credit like corporate credit and even spill over into the stock market, which has been the case previously. But generally, as we will need to have more faith in the willingness and the ability of our government to print money as the ultimate solution to every problem. And we know in extreme situations that the real function of the central bank, or the Federal Reserve in this case, is to print money when necessary to make sure the government gets financed. But as we've seen, dating back a long time, I mean, the policy of the central bank to continually to step in to lower interest rates and encourage companies and people to take on more debt to help us in the recovery. I mean, this has been in place since the 1930s. And the idea that the central bank could push interest rates down, make more credit available as a notion, or as a way to smooth out the business cycle, mute these huge cyclical dislocations, and really design it to have an economy that operates with fewer recessions, less severe ones when we do get them, and then ultimately longer periods of expansion. I mean, this is essentially, the kind of the tack that we've taken over the last couple of recessions is to issue more debt and just kind of flood the market with liquidity. And really almost not let the cycle play itself out as it normally would. And it's just saying almost that we're going to, the Fed's going to step in and do whatever it takes to kind of mute out whatever cycle adjustment is probably going to happen. This policy has worked to kind of stave off these huge depressions, so to speak, but it's also created this what they call a debt super cycle, and that in and of itself has created a lot of its own distortions in the market. So every time we get ourselves into a recession, there's this thought that the total debt of the U.S. economy is going to rise relative to gross domestic product, and it's going to continue to go higher and higher, which is just frankly not sustainable. This is the thesis of this particular research, which I happen to very much agree with. And there's a moral hazard tied to that. I mean, that you can't just assume that you're going to increase your money supply by 70% on an annualized basis and not have consequences. I mean, obviously this is a short-term phenomenon, but the idea that we can increase ad nauseum our public debt and not have the consequences to have to deal with down the road is not relevant. And the risk of this high credit issuance on the part of the government is actually crowding out other buyers. So when you think about this, there's a lot of issuance being done by the Treasury, and it's crowding out other issuers in the corporate sector and so on and so forth that are trying to access the same buyers for that paper. So you're getting a high supply, which means that you're going to drive prices low, and which means in turn that you're going to have higher yields, which is not something that we necessarily want at this particular juncture. Now, this is a chart from a recent article in the Financial Times, just highlighting the developed world, if you will, the government financial liability balances. And so the OECD is kind of generally characterized as kind of the rich countries, the rich developed countries in the world. And what this chart depicts is that the average government financial liabilities are expected to rise from 109% of gross domestic product, or the collective economy of these OECD countries, to more than 137% this year, which leaves many of the countries in the OECD with debt burdens that are just astronomically high. And, the country that comes to mind that kind of fits this bill is Italy, that is kind of often looked to as the kind of the poster child for a massive fiscal imbalance problem, where there's a kind of an unsustainable legacy of fiscal imbalances. And in fact, if there's a delay in, or a fairly significant second round of coronavirus, and the pandemic extends further, I mean, debt levels that are depicted here could rise even higher. So what it's really just telling us is it's signaling that we're not going to have this V-shaped recovery, which we weren't anticipating anyway. But I think it's just kind of re-emphasizing the fact that with these financial distortions, that it's going to be a little bit more protracted in the recovery. And this article goes on to say that basically that the OECD said that public debt amongst its members rose by 28 percentage points of their economies during the financial crisis, and it's going to be a lot worse than that this time around. And that with governments introducing additional fiscal measures, ranging anywhere between 1% in France and Spain to 6% in the U.S., that these measures are likely to be outpaced by the rise in public debt, because in a deep recession, your tax revenues tend to fall even faster than your economic activity does. And there was a point in time about 11 or 12 years ago, when we were in the midst of the financial crisis, that there was a school of thought that said that if you were a country that had more than 90% of that your outstanding federal debt was more than 90% of your economy or your GDP, that was a level that was deemed unsustainable. And since then, that theory has been debunked a little bit, but what is clear in the data is that if you continue to allow public debt to build up higher, that will ultimately threaten and likely undermine private sector spending, basically creating a protracted period of slower growth. And then the case study that is often highlighted to really emphasize that point is the case of Japan, frankly. And Japan, being a country that back in the early 90s, when its own financial bubble cracked, had extraordinarily high levels of debt, and as we've seen, has witnessed several decades of much slower growth overall. And this chart really just represents the sectors within the S&P 500 and the earnings per share growth for each of those for the first quarter. And we've had most of the companies in the index report now, so we have fairly good handle on what the data looks like. And not too surprisingly, you can see that there's kind of a bifurcation across the economy. So even though we saw a general decline of around 14% or so, that it was not distributed evenly, that obviously consumer-related companies that were impacted in the last month of the quarter, financial, industrials, energy companies we know have been considerably impacted, that those companies within the index in those industry segments fared far worse than did the healthcare and technology sectors, which you can see over on the right-hand side. Now, this chart will look fairly similar, we believe, in the third quarter, although I'm not sure that we're going to see, in fact, I'm pretty sure that we're not going to see any bars that are positive. The earnings per share year over year for the third quarter, for the second quarter is likely to be considerably worse based on the weight of April's weak activity. And in this chart, we really spend some time looking at the last several recessions and kind of critiquing, or maybe even handicapping, if you will, what we might be able to expect this go around. And so, this goes back over the last 4 recessions, and obviously the first 2 that you see on your left are different from the second 2 that you kind of see towards the middle, going towards the right. That then the 1981-1982 recession, the downturn lasted about a year, and the recovery was fairly stark. Again, different circumstances. We had tremendous amount of inflation. We had a Federal Reserve chairman that was just hell-bent on fighting inflation at that point and raising interest rates. So different scenario. 1990 to 91 kind of bracketed that period around the Iraqi invasion, and that was fairly short too, both in terms of its downturn and the ensuing recovery. But in the next 2, we saw a fairly prolonged period of downturn. That in 2001, obviously we had 9/11, we had the tech bubble bursting, and that was really painful. And there was a lack of visibility on where things were going to go, and there were a lot of people who didn't want to catch that falling knife, so they just stayed away. And so we had several years of not only the downturn, but then we had several years, frankly, of this recovery that followed. And then similarly, in coming out of 2008, 2009, we saw a fairly strong, almost a year and a half downturn related to the financial crisis, and then it took us quite a while to build ourselves back. And so if we look right now, we've had a fairly short downturn so far, and we think that April is probably the low point in this recession, because we've manufactured the shutdown, and we've had a widespread economic decline. And the question is, how long is it going to take us to kind of extricate ourselves from this and rebuild what we've lost? And the original thinking was that it was at least 12 to 18 months. I think the conventional thinking now is somewhere closer to 18 to 21 months. That kind of puts us into 2021 as a kind of a focal point, maybe the first quarter, where we can expect to perhaps get back to where we were when we exited 2019. In showing this chart is just kind of imparting our thoughts that maybe it's going to look a little bit more like the latter 2, the 2001 and the 2008 global financial crisis scenarios, than it will look like the first 2 that you see on your left. But again, there are things that we don't know, but we're obviously very optimistic, and we know that we will extricate ourselves from this at some point. But the question is how long, and so that helps us to prepare in terms of investments and allocations and things like that. We sure hope that you've enjoyed this segment of Charts of the Week. We hope that you join us next week when we have more interesting tidbits from our weekly research activities. You are always welcome to reach me at the information provided on your screen right now. And we look forward to your comments and suggestions. And if you have something that you're particularly interested in, we'd love to know more about it. So with that, we hope you have a wonderful week, and thank you for joining us for Charts of the Week.